So the dominating theme in fixed income markets this year so far, at least in corporate bond markets, has been the hunt for yield. Investors looking at various investments to get a return in this low yield environment. And this has led to spread contraction in developed markets, especially if we look at the European high yield spreads. The iTraxx crossover index is at 230 basis points now, which is the lowest level in multiple years. And it's more than 70 basis points tighter than it was just a few months ago. We've even seen that investors have gone beyond the borders of developed markets and went into emerging markets, where we've seen a very strong demand recently. The most recent example was Argentina, which were able to sell almost $3 billion US worth of 100-year denominated bonds. So as we look into the rest of 2017, we think there's reason to be a little bit more cautious, especially as valuations are getting increasingly stretched at these levels. It's always difficult to say what the trigger can be, but a potential trigger could be a lower credit impulse from China, which could hurt global growth, could cause a global growth slowdown, and also cause a sell-off in commodity markets. In the past couple of weeks, we've actually had a little bit of a preview with the recent sell-off in commodity markets, the drop in oil prices. If we look at US high-yield credit, we've seen a little bit of a sell-off there and credit spreads widening a little bit again. We are not nearly as wide levels as they were in early 2016 when the oil prices first dropped and we saw a more widespread panic in financial markets. But obviously that could return if we saw a wider sell-off in commodity markets, which could be a consequence of a lower credit impulse from China. Other markets that could be hurt by a slowdown in China could be Brazil, which is very dependent on especially its iron exports to China. We've already seen some political turmoil over the past couple of years in Brazil, and these seem to have erupted again as President Temer has been drawn into the corruption scandal there yet again. Another market that we're looking at is Russia. Russia has enjoyed a very strong performance for its credit markets in the last 3 years. But if we see a renewed drop in oil prices, we know the Russian economy is very oil dependent, so that could lead to a sell-off in that market as well. It's not all bad news for bond investors though. Government bonds are probably going to do better in this scenario. A major theme this year has also been central banks and the tightening of monetary policy. Already Federal Reserve has hiked interest rates a couple of times, and throughout this year investors have been guessing as to when the European Central Bank will start tightening its policy. Obviously, if we see a slowdown in economic growth, then the central banks would likely be back on the defensive again. That would mean lower government bond yields, and it will also be good news for everyone with a mortgage.